welcome to the July 2022 edition of the Economist Intelligence Unit's Global Outlook video. My name is Agathe Demarais and I'm the Global Forecasting Director at EIU. I'm joined today by Cailin Birch, our Global Economist in the EIU, based in London. Today, we're going to discuss potential triggers for a recession in the US amid sky-high inflation and slowing growth in America. So, Cailin, I'm going to turn to you for a first question. We've seen a raft of bleak economic data lately coming from the US. Do you think we're heading for a recession in the US?
Well, no, for the moment, we think it's likely the US will probably avoid a recession, but probably only narrowly. There are a few reasons why we think the outlook might not be quite so bleak as current data suggests. One of those is that there's a strong rise in household net wealth we've observed over 2020-2021. We've also got record low unemployment, the fastest wage growth that we've seen in years, albeit below inflation, and stability in the banking sector that we saw recently in the latest Fed stress tests for US banks. And because of that more solid economic base, we think it's likely actually that consumers will be able to weather that higher cost we're seeing from inflation and higher interest rates from the Fed pace of tightening. Now, we think GDP will grow, but at a more or less effectively the slowest rate that it possibly can without going into recession. So it's not a really positive outlook, but we don't think a recession is inevitable. Now, that said, the risk of recession has certainly risen sharply since Russia's invasion of Ukraine. And we see three main avenues, three main risks that could potentially push the US economy from its current kind of stasis outlook into an outright recession. One of those would be another spike in inflation above where we're already hovering. The second would be an overly aggressive Fed. And the third would be a potential collapse in asset prices. Now, the most salient of these risks is the overly aggressive Fed. We think the Fed's going to have to walk a very fine line over the course of the next 18 months, really, working to raise interest rates fast enough to cool demand growth and contain inflation expectations, but without causing an outright contraction in consumer spending. Now, there's a risk that in trying to walk that fine line, the Fed will either misinterpret retail sales and rising wage data, which is usually nominal and really quite high frequency. We'll see probably some positive data over the summer, continued wage growth, for example. The Fed could misread that as a sign of stronger demand in the US than we really have. Powell said at the last meeting that the economy is still running hot, but actually we see some signs of weakness there. Now, if the Fed becomes overly optimistic and then tighten too quickly, that could be a real issue. The second potential risk is that the Fed will feel the need to move more aggressively to raise interest rates in order to bring down inflation expectations. So effectively to convince consumers that they're going to be able down the line to rein in inflation. And actually in either case, if the Fed raises interest rates too quickly, say by another 150 basis points in the next 2 months, the next two meetings rather, this could actually cause consumer spending to collapse rather than to slow and prompt an outright recession.
And so you talk a lot to our clients as the EIU's Global Economist, and I suspect that they ask you about the other two risk factors that you've mentioned, a surge in inflation and a collapse in asset prices. Can you tell us a bit more about these two risks?
Right, so there are these two big kind of looming risks. For one, to tackle inflation first, we at the moment expect inflationary pressure to start to subside in the second half of 2022. And that assumes that global commodity prices start to level off, albeit at record high levels. However, several factors could change that scenario. For example, another escalation in the Russia-Ukraine crisis, if access to Russian energy supplies were to be cut off completely, or if a new and more serious COVID variant were to prompt widespread lockdowns. Lots of things could push us into a much more worrying scenario. Now, asset prices are also a concern. US stock markets have soared in recent years despite economic hardship from the pandemic, and as consumer spending has rebounded quickly. However, price earnings ratios still suggest that many stocks are still overvalued. And if the economic outlook were to turn, if real consumer spending, for example, were to contract, this can actually prompt a collapse in asset prices, which turns into a very negative cycle for consumer spending as households see their savings starting to dwindle. So on the whole, our core scenario is still fairly positive, but there are some really important risks to keep an eye on.
Thanks so much, Cailin. And you can always find our latest global analysis as well as a fantastic white paper, which Cailin has authored exactly on this topic, 3 triggers for potential US recession, on our website, www.eiu.com. Thanks for watching us today and see you next month. Goodbye.